lot of great stuff to talk about today. Hey, it's been a really tough time to invest, and it makes it hard to participate in an investment competition where you're supposed to be buying stocks when the market's so choppy and is in such bearish territory. But don't despair. There are ways we can handle this. So let me get some slides ready, and I'll share them with you here. So welcome to our ongoing series of market updates for the Youth Sustainability Investment Challenge. I guess what I should do first is, before I do anything, I want to make sure that everybody has signed up for Stock Track. So I've got my dashboard open here, and I can see we've got 141 registrations. Hey, that's pretty good. That's up from where it was last time. We only had a handful. And I refreshed by the end of the class, and more people had signed up. So I guess you guys are getting on that, which is excellent news. Let me see who's in here. So this is something we can check every. Oh, we have this turned off. View account details. Okay. Okay. Not an investment team. Echo Can Finance. Okay, yeah, all the way. So we've got a lot of people in here. This is really good. All right, so no positions found. That's right. It's not active yet, but it will be. Lynn, when are we starting? Monday morning, tomorrow morning, 9:30 a.m.?
Yeah.
All right, that's excellent. So let's talk a little bit about what's going on in the market right now. I'm sure you guys have a pretty good idea, but I'm going to get you caught up. And then we'll talk about what to expect next week. And then we'll talk for a minute about something called GICS, the Global Industry Classification System. If you've taken classes with me, you're already somewhat familiar with it, but we'll talk about it a little bit shortly. So we had a terrible S&P 500. We're down from a high of 4,818 to, we hit a low of 3,636, and we're just above that level right now. And it was just an absolutely horrible week for the S&P 500, as you can see. It was a terrible day on Monday. It was a terrible day on Thursday, and Friday was not really much better. Things just, the news that was coming out just kept getting worse and worse. So what do I always say makes stocks go up and down? Anybody want to say it? What makes stocks go up and down? Why do stocks even have a value at all? No, everybody's going to stay quiet? All right, that's fine. Listen, so, oh, we got some comments in the chat. Supply and demand. Yeah, well, you know what? You're right. And I always tell people that if people ask me, why is the market down? I say, well, there were more sellers than there were buyers. Essentially, it is supply and demand. And Alex says news, and you are correct. And in addition to news, it's more about consumer confidence. There you go. That's, yeah. So it's those expectations of earnings, right? So stocks have value because it represents ownership of the company, and you buy the company because you want to get the earnings, you want to get the money, and you want to get the dividends, or you want the company to grow, or whatever the case may be. But the company is supposed to grow and have earnings. That's why when you see changes in earnings, stocks will go up and down. When you see changes in growth rates, stocks will go up and down. If people are expecting 10% growth and you only get 5%, stock's going to go down. I almost guarantee it. And the other big thing is that it's a discounting mechanism. This is why we talk about the present value of future cash flows, and why we do things like discounted cash flow analysis. It's not just the earnings that we're getting today, but it's the earnings we expect to get in the future. The future expectations are really what drive stock prices up and down. A company can meet on its earnings and then turn around and lower its guidance, and the stock will go down. And one of the things that drives that is, exactly as you're pointing out in the chat, maybe some macroeconomic indicators like consumer confidence, consumer spending, unemployment rates, interest rates, things like that. So let's look at some of these things, and we'll look at it in this order. So I guess we'll look at earnings first. because there were some really atrocious earnings that came out this week. So, it started at the beginning of the week with Oracle. And what we're seeing at a lot of tech companies is the same thing. They're missing and or they're beating, but they're still losing money. So we've got a serious problem in tech land where they're either earning less money than we thought, surprising people and making their shares less valuable, or they're losing money, which obviously when interest rates go up, makes the shares less valuable. So it's been real tough. And you can see what happened to Oracle stock today, or this week over the last 5 days. They reported after the close, I believe, on Monday. And so, you got a really weird price action here because the stock actually opened higher and then sold off and then fell off a cliff at the end of the day and then continued down. So for some reason, somebody thought the stock was going to go up and it got bid up there for a little bit of time. And that's kind of why you have to be careful and use limit orders when you can, because you might not know where the stock is going to open the next day if there's an earnings announcement. And if you put in a market order, you might be the person who bought the stock here. If you put in the order like Monday night after that earnings release comes out and you're like, oh, it's not that bad, and you put in a market order, your trade's going to get executed first thing in the morning up here, and then by the end of the day, you're way down here, and that's not really a good thing. So if you're buying stocks on a day that there's an earnings report, make sure you use a limit order. All right. By the end of the week, we had more of the same stuff out of tech. We had Adobe missing by only a little bit. They're expecting 265 and 263 is what we got. But still, even though it only missed by a few pennies, the expectations are going to be lower now, that the growth is not going to be what we expected, and the future earnings could come in lower. And so we saw the same thing happen with this stock. It just kept going lower and lower and lower. So this was on, I think, Thursday's report, and then you can see what happened after I was on Thursday. Stock fell right off a cliff. Now, interestingly, one company beat by 350%, and it's Bolero, which I believe is a bowling alley company. And when we get to some macro reports later, you'll see that one of the things where consumer spending went up is like going out and drinking. So that's what people do when they go bowling. I guess that economic report was accurate because companies, leisure type oriented companies, are seeing improvement. And I guess a lot of that has to do with the demand destruction we saw from the price of gasoline. And I always talk about demand destruction. So if you go to the gas station and gas is $2 and you say, here's $20, you're getting 10 gallons of gas. But if the price of gas goes up to $4 and you still put in $20 in your tank, well, you're only going to get 5 gallons of gas. Either that, or you're going to spend $40 to fill up your gas tank. And then what that means is you're not spending that extra money somewhere else, causing demand destruction. When you see the economic report later about consumer spending, it's really kind of misleading because the consumer spending number can stay the same, but the amount of goods that were sold and transported around the economy went down. And that's the next thing we got to talk about, because on the next company, there was some absolutely shocking news. And this is one of the companies that is really important to the economy because they ship things not only internationally, but they deliver things for Amazon. And we know Amazon's been under pressure recently. But let's watch this news clip real quick, and then I'll tell you about it a little more.
FedEx issues an earnings warning, and the stock is getting crushed this morning. That phrase gets tossed around a lot, but we are not exaggerating in this situation. That stock off by 20%. Frank Holland joins us right now with more. And Frank, a lot of questions about what happened here and whether this is a FedEx problem or really a systemic one.
Yeah, certainly a lot of questions about this report and what it means for the entire economy. Let's start with FedEx. Shares plummeting, as you mentioned, after a revenue and EPS miss. Profit 33 below estimates in this earnings warning. CEO Raj Subramaniam on Mad Money last night, when asked if we were on the brink of a worldwide recession, he said yes, saying a major factor is a slowdown in China after COVID lockdowns.
Asia is the center of manufacturing in the world.
Right.
So when you see these things happen, I feel it's leading indicator of something, more profound. The U.S. has been somewhat insulated because the U.S. dollar is, is the currency of choice for the world, and there's some insulation there. But I do see the U.S. is slowing down too.
FedEx guidance, just about as bleak as those comments. Q2 EPS guidance about half what the street is looking for in estimates. FedEx also completely pulling its full year outlook. Back in June, FedEx actually raised its dividend by 53%, a sign usually signaling business confidence. To now cut cost, FedEx is reducing flights for its signature express air delivery service, cutting hours for workers, and closing about 90 FedEx office stores. FedEx did reaffirm its fiscal year 2025 targets it laid out in June during its Investors Day. Analysts are having a lot of questions about how the company reaches the profit and revenue goals in particular in light of this earnings warning. The news also hitting other transport stocks. Rival UPS falling hard in the pre-market along with other names like Union Pacific, C.H. Robinson, and Maersk that are closely linked to Asia, U.S. imports, and consumer spending. Back over to you.
Okay. So
Shepard Smith here.
let me back this up 1 second and get rid of this banner down here. Yes, so those stocks listed right there are the other transportation stocks that were also dragged down in sympathy with FedEx. And it remains to be seen if this is a FedEx specific item or if this is going to become a problem for all transportation companies. We don't know yet. We know that we narrowly avoided a major supply chain disruption when all of the railroad workers wanted to go on strike at once. And it got so bad, the White House had to step in. Joe Biden himself had to get involved in the negotiations, I think, between the railroads and the workers union. And he sent some negotiators to make sure everything got ironed out right before they went on strike, because that could have been a disaster. But be that as it may, the FedEx report is pretty bad. And they're saying there could be a global recession. And if we're having a slowdown here, that's one thing. And a lot of that's due to inflation that started a long time ago. But after we had inflation for over a year. It hasn't gone away. It's only gotten worse. And then in Europe, of course, their energy prices are going through the roof, not for the same reasons that we had here in the US, but because they get most of their energy from Russia. And Russia's upset about the way they're being treated during their war with Ukraine. And so they're turning off the natural gas supply and not selling them oil either. So that's been a big problem for Europe. They're going to have energy shortages, and that'll be very disruptive. And then in Asia, as they mentioned in the video, we've got COVID lockdowns in some major cities. They're not, major by the standards of China. But if you have 10 or 20 million people, that's still a big city. The cities like Chengdu and Guiyang have been locked down for a long time now. Anyway, let's get to what they actually said.
To Asia, U.S. imports, and
and the reason I wanted to highlight that slide he had on the screen there about the transportation companies will become apparent in just a second. All right, so global volumes decline as macroeconomic trends significantly worsen. And we're going to have to talk about some macroeconomic trends here after we discuss earnings, both internationally and in the US. We're swiftly adjust, blah, blah, blah. All right, this is a quote directly from the CEO who you just saw a video clip of. So that's all you need to know. Global volumes decline as macroeconomic trends significantly worsen. And the next quote is from later in that press release. All they did is pre-announce earnings. Companies will do that often because they don't want you to be so shocked when they put out their earnings release that the stock goes to zero. But this one's pretty bad. I guess I shouldn't laugh. This pre-announcement is so profoundly bad that the stock went down, I think 21% anyway on that day. So here's the guidance they gave. And if you've taken my classes, we'll start building out financial models. And the best thing you can do when you're building financial models is looking at the company's guidance, looking at their outlook. Sometimes they'll just come flat out and tell you what the EPS number is going to be. Well, in this case, they used to, but now they're not going to. FedEx is withdrawing. Oops, I need to sit a little closer here so my screen isn't bouncing around so much. FedEx is withdrawing its fiscal year 2023 earnings forecast. All right. When you start seeing companies doing that, it's a very, very bad sign. You never see that unless we're heading into a recession. I remember in 2000 when the dot-com bubble popped, you had all these companies saying, we are withdrawing our guidance, or we have no visibility on forward earnings. And if they say they have no visibility, it means things are really bad and they don't want to tell you. And basically that's what they're telling you here. They gave guidance just a couple months ago, and now they're withdrawing their guidance. So they have no confidence in their ability to predict their full year earnings. However, they did give guidance for the quarter because they already know what the number is, and they got to tell you if they're going to pre-announce, they're going to tell you. So it was earnings per share of 265 or greater. Here's their revenue guidance. The problem with this number is that the estimate is for like $5 or five. It was like almost double that. So they cut their number so low that it's incredibly below. It's going to be an incredible miss. I don't see how the stock's going to recover anytime soon. This is not going to help. Repurchasing $1 billion of common stock, that's not going to be enough to help. And you can see the results on the stock right there. It was an absolute disaster. Now, I want to talk a little bit for a minute about the Dow theory. Don't forget about that. And if you've taken the classes with me, we've talked about the Dow theory before. And so Alex, yes, exactly. Wouldn't withdrawing earnings forecast cause a loss of confidence? That's exactly what happened and exactly why the stock went down. Not just that they're going to earn less money, that's shocking enough, but withdrawing their guidance at all, they have no idea what's going to happen. Yeah, so people are going to be rightfully frightened to own this stock anytime soon. And yeah, I am bearish on the market because it's a bear market. Okay, so remember the Dow theory. And the Dow theory is created by Charles Dow, right about the time that he and Mr. Jones invented the Dow Jones Transportation Average and the Dow Jones Industrial Average. And so what the theory was, if you recall, was that if one index is going up and another index is not going up, then there's no confirmation. And their theory was that, and the way it's interpreted these days is that if you want to see the S&P 500 or the Dow Jones Industrial Average going higher, it needs to be confirmed by the other index. And in the case when they started this theory, the other index was the transportation average. And it kind of holds water, logically speaking, because essentially, if transportation companies are not doing well, that means goods are not getting shipped around the country. That means there's no demand. That means people are not buying stuff, so things are not getting shipped to their house. If they're not buying stuff at the store, then the store is not placing orders with the manufacturers. If manufacturers are not getting orders from the stores, they're not going to place orders with the raw materials companies. So if people quit buying, I don't say toasters, the store is not going to order as many toasters, so they're not going to ship any toasters. And then the toaster factory is not going to buy as much stainless steel from the stainless steel mill, and so no stainless steel gets shipped. And so the steel mill is going to buy less iron ore and coal because they don't need to make as much steel. You see my point, though. If the transportation companies slow down, it's usually a leading indicator as to what's coming next for the rest of the economy, because then it means if they're not shipping stuff, that means retail sales are not doing well, and probably manufacturing is not healthy, probably the production of basic materials such as steel or iron ore or coal, probably not going to be doing that well either. And that's why the transportation companies' stocks are down. That's why their volumes are lower. They specifically said that volumes were lower and pricing was lower. It's funny to watch all the Alexes talk to each other in the chat. Okay, so the confirmation theory is that in order for the stock market to really rally because the economy is doing well. Transportation companies have to do well, and their stocks have to also be doing well. If they're not, then there's no confirmation. And if their stocks start heading down because they're posting bad economic results or bad earnings results, you should probably expect the other stocks to start heading lower as well. Oops, that's kind of an impossible curve there, but I had to draw around the Zoom box. Let me draw that again because stocks can't go backwards in time. Okay, so that's the basic, in a nutshell, how the Dow theory works. One index has to confirm the actions of the other, or they're probably going to reconverge somewhere else at a different point in time, perhaps lower. So here's what we have on tap for next week: Accenture, Costco, and FedEx again. And this is going to be their real earnings report this time. This past week was just their pre-announcement because they didn't want you to be shocked next week when they actually tell you the earnings. I don't know that it made any difference, to be honest. But you never know. Probably what will happen is they pre-announce so low that when they actually report their earnings next week, they'll beat by a penny or two, and the stock will start to rally a little bit. But there's going to be a conference call afterwards. I'm sure there are going to be a lot of hard questions from analysts, and I don't know how well the CEO or the CFO are going to be able to answer those questions. And so it might be a very, very difficult and contentious call, because like they said in that video clip, they had just announced their earnings estimates for the full year a couple months ago, and suddenly they got cut in half. And wow, that's really bad. That's really bad. Anyway, so Accenture, of course, big consulting and accounting firm. Costco is a very popular stock in our stock picking games all the time. And one of the reasons why is because it's done so well throughout the recession caused by COVID and has continued to do well after. They have great pricing. They keep gaining market share. And if there's demand destruction and people don't have as much money to spend, what do? They buy in bulk. They go to discounters like Costco, and that's where they do their shopping. So the company has done really well. So I look for good things from them. All right, so now let's look at some macroeconomic news. It was bad this week, and it's going to get worse next week, I hate to tell you. So here's the S&P 500 for the past year. This goes back to 2021. And we had such a great rally. And then, of course, yeah, just straight downhill. We're near the lows. But we keep getting these little bear market rallies here, where for some reason people think, oh, bad news is good news. Oh, the Fed can't raise interest rates now. Oh, bad news is good news. The Fed can't raise interest rates now. No, Fed didn't say that. What they've been saying is they're going to keep raising rates aggressively, and they're going to keep them high for a long time. And they finally had to come out and say that last week. And then the market, of course, started trending lower again. So here was the news. Consumer price index came out, and it's not getting better fast enough. We're still in the 8-point-something% range. Now it's down from the peak because the price of gas has come down so much, which is fantastic news. So people can spend that money on something else. So it's sort of starting to relieve the demand destruction, but not enough, not by enough, because prices are still 8.3% higher than they were this time last year. Now the problem is that it's getting baked into other stuff. So here's a little cheat sheet you can use. This is available online. You can get it anywhere probably. This is from Bureau of Labor Statistics, but I use this one that was highlighted by Bank of America Merrill Lynch, because they put a heat map on it so you can see what's getting better and what's getting worse. And I would have done it the other way around, I suppose, with green being low inflation and red being high inflation, but they did it the other way around. So you want to start investing in companies, of course, in the industries where you see a lot of greens. And of course, it's come and gone for some things. For example, motor vehicles and parts, new vehicles and used vehicles. Well, it's up a little bit, but it had been a lot higher. We started at yellow, went to green, and now we're back down to red. So maybe they don't have the pricing power they once had. Whereas in other industries, like let's say, rent, maybe you want to invest in apartment companies, They started out low, and now rents are going up faster and faster, 2.74%. Owner's equivalent rent, that is a tricky one. And everybody knows that housing prices are up a lot more than 6.29%. But the way they calculate this number sort of delays it over time. And they ask the question, how much could people rent their home for if they rented out their house, or if they had to rent their own house for that matter? And that is massively understating the actual inflation in housing prices. So that went from 2.89 to 6.29. So that's a good increase. Got some other ones down here. Transportation, like airlines, went from 4.3 all the way up to 11.3. What's this one? Oh yeah, airfares. There we go. Get a little more detailed. Airfares, 33% year over year. So they're in a great spot because their fares are higher and gas prices are going lower. Jet fuel prices are declining now. So that's probably a good place to look. How about basic stuff like food companies? That's up a lot from 4.9 to 11.3. I'm just looking for stuff that started at red and then went to green. Education and communication commodities. Oh, that's down. That's actually showing deflation already. That had inflation, and now, so that's someplace where you don't want to invest. Lodging away from home down here is hotels, and that peaked in March of 2022 at 25%, and now has been going down. Now it's still positive, but believe me, when you have a stock, and I'm talking about hotel stocks in particular, and you're expecting 25% revenue growth every year, you price that into the stock. You think, wow, this stock is going to be worth a lot more if they have 25% more revenue next year because they have debt, they have a lot of leverage. So that means 50 to 75% more earnings per share. That's great. I'm going to pay double for this stock. But then if a few months later, that revenue increase is only 4%, you're going to be strongly disappointed that you paid double for that stock because the earnings per share are not going to go up much at all. And your dividends are not going to go up much at all. So this is a nice little cheat sheet you can use to sort of figure out what's going on in the economy and what sectors of the economy you'd like to invest and what industries in which you would like to invest. This is important because we're going to talk about this at the end of our little market update when we're going to talk about GICS, or the Global Industry Classification System. It's something that we have to use for all of our investment competitions. All right, so let's just get straight to the report. Make sure my share sound is still on.
It's time now for the report. Rick Santelli, hopefully you've got the numbers for it.
Yes, the August numbers for the Consumer Price Index, headline number expected to be down is up 0.1 instead of down 0.1. And do remember the high water mark there was in June when it was the highest level since 2005 when it was up 1.3%. Up only 0.1, of course, is the lowest. Well, since last month, we're unchanged. If we strip out the all-important food and energy, and do understand, gas was down, 26% month over month. It's food that we have to pay attention to, up 0.6%, double the expectation. And the high water mark there is up 0.9. That was in April, and that went back to 1981, up 0.6. Well, if you look at up 0.7 in June, that's kind of our comp. Now, the year-over-year numbers, expecting up 8%, up 8.3 on year-over-year, up 8.3. High water mark there was, of course, 9.1. That goes back to 1981. 8.3 equals April, and it is the lowest level since February when it was 7.9. And if we strip out the all-important food and energy on a year-over-year perspective, it's also hotter than expected, up 6.3%. We're expecting up 5.9. The high water mark there, up 6.5. That was in March. That was the highest since 82. So when we see 6.3, that actually now is the highest since March of when it was the highest since 82. We've had 4 months in a row where it was moderating a bit. We'll call an end to that. Now, as we look at interest rates, we can clearly see that there's a lot of two-way action going on here. But for the most part, we're at 339 and a 10. That's up about 4 basis points. And we were at 3 29, down 7. So you can see there's been a big reversal. And the panel, of course, is going to discuss this. The thing that really bothers me with regard to inflation is everybody here on this panel agreed months ago that one of the reasons inflation was high was all the government spending. And after we agreed on that, what did the government do? They spent more. Student loans, welfare in terms of the CHIPS Act. Seems like nothing is sinking in. These numbers aren't better than expected, and maybe they should be, and maybe ultimately they're going to start to go back up again because we continue to go back to that well of debt and spending. The gang, back to you.
Yeah, we've had policymakers on, and to there are no exceptions that they don't cop to that at all anymore. Rick, it's supply chain, and gas prices have been coming down, and all our efforts are working. And one representative just said, just to be clear, like I was asking like insane questions about whether we should still be spending, but I don't know. Austin, or let me. How about you, Steve? What are you seeing there? Give us some more details.
I think the important story of this, Joe, I'll get to the detail in a second. The important story is the Fed just erased the 75 basis point hike that was written in pencil and wrote it in red ink. I think this moves them to 75 for sure at this point because they didn't get the help they were looking for. And I'll tell you where it didn't come from. Rick was 100% right to point out food. I think that's the reason why you didn't get negative. What was it? 0.08 on the food number. That was a big thing. 0.8 on food. Food at home was up 0.7%. That was over on the core side. On the headline side. On the core side, two things. One is I am not seeing, Joe, some of the deflation from the excess inventory that people thought was going to show up. I'm seeing goods prices up a bit. I'm not seeing too many negative numbers. The one negative number I see there is used car prices down actually less than had been expected by some forecasters I was reading, down just 0.1%. And then you have this a new car number up in a pretty healthy way. The other important component here is the housing component. Owner's equivalent rent used to figure out the cost of housing up 0.7%. There may be some moderation in rents out there, Joe, but it's not showing up yet in the inflation number, so it's not helping out the core. It hurt the core. And what you remember, Joe, we had this lag before it came into the inflation numbers. It looks like there's going to be some lag getting out, if that's true at all. So Fed has more work to do, I think, is the bottom line.
All right. So
it's time now for the report.
We already went over the chart, but to summarize,
it's time now for the report.
It really doesn't. All right. So here's the big problem that they're mentioning. It's the same glasses. Probably are the same glasses. I have no idea. It's funny. The problem is, everybody in the government didn't want to look at the headline number when it hit 9%. They wanted to take out energy prices and food and look at core CPI. That's what they call that when you take out food. And if I back up, you'll see what I'm talking about. So you got your headline CPI, which is 100% weighting. Then you take out food and energy, and then what's left is core CPI, about half of which is shelter, housing prices, and hotels, and rent, things like that. So the problem is those are starting to accelerate, not the volatile ones, but the ones that shouldn't be going up that much. And so that's why we have these issues. And the government will say things like, oh, inflation isn't that bad. Core CPI isn't up nearly as much as headline CPI. And now when it reverses, they say, oh, look, inflation's coming down because gas prices are going down. The problem is it's not gas prices anymore. It's seeping into other areas of the economy. And core inflation had been getting lower, but now is trending higher. It came in much higher than expected and is trending in the wrong direction. And that means the Federal Reserve is 100% guaranteed going to raise interest rates next week. And it's going to be a shock to the stock market. I know that it's going to be, they might go 100 basis points, 1 full percentage point. Who knows? There's a lot of talk about that this week because inflation's not getting better. It's suddenly getting worse again. All right, so here's another interpretation. I'm playing this because it's an entertaining one, and it's from, this is a professor, Jeremy Siegel, who teaches at that Ivy League school over there in Pennsylvania. that we're not affiliated with, by the way. But he's a very wise and learned professional, and he's on TV all the time. So let's hear what he had to say.
He's been outspoken, not only on inflation itself, but what the Fed should do about it. And Professor, it's great to talk to you today. You had made the argument that inflation is coming down broadly and that it was going to lessen what the Fed had to do. You want to rethink that today?
I want to elaborate on what Steve has just talked about, and that is that we've actually had a lot more inflation over the last 18 months than recorded in the official statistics, and we're going to show a lot more inflation next 18 months, and there actually is going to happen. And the reason is specifically housing and the way the government puts housing into those statistics. For months, as Josh just said, we had 40% rise in housing prices. If you look at the CPI housing index, it was up like 7 and 8% because of the way they do the calculation. So it understated over the last 18 months. It's going to overstate. If you're on the ground today, you talk to real estate brokers, they say prices are not rising anymore in real estate. In fact, they are falling on a nationwide average basis. Will you see that in the CPI? No, you will not see that in the CPI for 18 months. What I'm saying is that we're going to get that overstatement just like we got the understatement. Now, that's the risk of an over-tightening Fed. Now, yeah, the Fed will go 75, and they may go 50 and 50 again, like Goldman Sachs said. We may get over 4%. Let me also remind people, that, hey, that sounds attractive. The long-run return on stocks is over 6% after inflation. This is a 4% before inflation.
Professor, you can't suggest 75. Oh, they may go 75 and they may go 50 and then another 50 and be bullish the stock market in the same time, can you?
Well, it's already built in. That's why you have a 3-4% drop today. It's already in the future. I think that they're actually anticipating that. My feeling is that, if they see the slowdown, if they take a correct view on what future inflation is, they may not have to go that high. That's the relief the market is watching. Are is inflation really proceeding, or is this just a lot of statistical distortion because of the way in 1981, they totally changed the way housing prices go into inflation? Don't forget, housing prices, 50% of the core rate, almost 50%. If they're not going up anymore, you knock the core rate in half of what we just saw. I'm just telling you the statistics versus actuality. Yes.
Professor, maybe it's going to be stickier than you thought. Maybe they're going to keep their rates up longer at this level, if not higher, than you think. Doesn't that
would be the policy
dynamic
mistake
for what the stock market can do?
But
isn't that more likely than not at this point?
Well, listen, I think they're going to look at the economy, and I hope they understand what the statistics are versus what the on-the-ground inflation is. And although they have to stand firm now because, as Josh said, they really made a terrible mistake by staying low way too long, we're all expecting and hoping they're not going to stay tight too long. But the market is a bit nervous about that. But listen, when we say tight too long,
Professor,
they're going to look at the data.
Yeah, so the risk is that they might.
He's been outspoken
too long. The expectations now are much higher. In fact, this is a survey that now says that a lot of investors are they say there's about a 47% odds of a full 1 percentage point hike in interest rates. If they hike 100 basis points or 1%, the market's going to be shocked and it's going to sell off. But now, on the other hand, if they don't hike 100 basis points, and they only do 75, then or 0.75%, then maybe the market will be relieved and maybe it will stabilize. We'll see. But the the Fed's commentary has been really hawkish recently. And so, here's another expectation survey, and you can see that we had a lot of these bear market rallies because the expectation was, and you can see here, the expectation that there would be a rate cut was rising, and it was above the expectation of future rate increases. People were saying, wow, good, the Fed will raise rates, the economy will slow down a little bit, inflation will stop, and then they can turn around and lower rates next year, so I'm going to buy stocks now because they're going to go back up again next year. Well, those expectations have completely reversed now. The expectations for 2020 rates are up over 4.175, and the subsequent rate cut expectations sort of fell off the chart. Yeah, the expectations had been that they would cut a lot more, but then I don't know. Maybe the expectation is they are going to cut more. Who knows? But it's so weird how this is Bitcoin, and it has nothing to do with our stock investment challenge or sustainability. It certainly has nothing to do with sustainability, right? We know it uses a lot of electricity and has a huge carbon footprint. But I just throw it on here because for the longest time, cryptocurrency investors, or I shouldn't call them investors, speculators, would like to say that it's a great hedge against inflation. And when it turns out you get a bad inflation number, what happens? Cryptocurrencies tank. And it's a bad week for cryptos as well, unfortunately. So all around, bonds were down, stocks were down. And then, so later in the week, we had retail sales numbers, and they came in okay. In fact, they were better than expected. It was supposed to be flat to up 0.1%, and it came out 0.3%. Now, a lot of that, of course, is inflation. So, if prices go up, you have to spend more money on buying the same amount of stuff. But it turns around the decline. We'd been trending the wrong direction and had negative retail sales, which is kind of shocking to the market. And of course, back then, in July, we had a bear market rally, and everybody said, oh, look, retail sales are bad. That means the Fed won't raise interest rates as much. And they'll turn around and pivot and start cutting rates soon. And nope, now we got a positive number. So that's a scenario of bad news was good news, and now good news is bad news, because now the Fed's definitely going to raise interest rates more. And here's another key economic indicator that I always look at because it's a great leading economic indicator to determine when the expansion is over and when you might be heading into a recession. And this is the weekly jobless claims number over the past year. And you can see that things started to come down and bottomed out around April. And then we had this worrisome trend where first-time jobless claims were actually rising. And usually when you see that, that's something that will lead to future unemployment raises, increases in the unemployment rate, which leads to lower consumer spending, which leads to lower economic output, which leads to declining in GDP, and of course leads to recession. Well, interestingly enough, we've had a trend where it's not just 1 week, but we've had several weeks where it's then trending lower. And that's I guess, a good sign for the economy. That's wonderful. But at the same time, it's a bad sign for the stock market because, well, the economy's not slowing down as much as the Fed wants it to. They're going to hike interest rates higher and hold them there longer. So we've got to worry about all these things. And here's the report on that.
Yes, and there is a litany of data here, so I'm going to go slowly. On initial jobless claims, 213,000. That is definitely below the expectations, and at least till we get a revision, that's 9,000 below last week. Last time we were down at 213,000 was a while ago. I would say we'd have to go back to the end of May to see a lower number. Continuing claims, 1,403,000. A very, very nice drop there. We're expecting a number closer to 1.475, so that's good news. Indeed, Empire Manufacturing. Now, this is September number. It is down 1.5, down 1.5. And even though that isn't good news, we're expecting down close to 13. And the big number lately has been, that was in April when it was down almost 25 points. And last month, of course, down 31.3, has yet to be revised. We haven't had a positive number there, well, since July. If we look at retail sales, up 0.3. We're expecting down 1/10. Very solid number. Strip out autos, and you can see that autos kicked in a lot to the headline because you go exactly the other way, down 0.3%. Strip out autos and gas, it goes flatline, unchanged. Philly Fed. Now, Philly Fed's always an important number, and we want to pay very close attention. Minus 9.9. That's a big reversal. Last month, we went positive at 6.2. We're expecting a positive number. That is a disappointment. Import prices for August, month over month.
We don't have to look at all these. Philly Fed, I didn't even talk about earlier. It's, the different Federal Reserve banks in the different regions of the country put out their economic reports. And you don't want to see negative numbers from them. That's definitely bad. Okay, so here's what's coming up next week. Fed interest rate decision. Also, the Fed interest rate decision. And don't forget the Fed interest rate decision. It's going to be the most important news of the whole week. And forget about other earnings and stuff like that. That's going to be the thing that's really going to drive the markets. Hopefully they raise interest rates enough where they can finally start talking more dovishly about they can moderate the pace of interest rate increases because they're seeing a decline in the rate of inflation or something to that effect, although I wouldn't expect it. Okay, so we talked a little bit earlier about the different industries in which you can invest. And you want an industry with pricing power, of course. But let's talk about the GICS, otherwise known as the Global Industry Classification System, before we wrap it up for today. This is directly from the S&P 500 fact sheet, directly from S&P, Standard & Poor's. And this shows you basically how the S&P 500 is broken down. If you've taken my class, you've seen this chart before. And so you've got 11 different sectors of the economy, and this is based on GICS, the Global Industry Classification System. And the way that MSCI and Standard & Poor's collaborated to establish the GICS is they looked at the economy, they looked at the stock market, and they tried to get an index that had stocks in it that sort of matched the broader economy. It doesn't include all the stocks in the stock. The S&P 500 is not the 500 largest stocks. I'm sure you know that, but just to make sure, because some of the indices, they just like the NASDAQ 100 is the 100 biggest stocks in the NASDAQ. But even though it is a large cap index, it's not all of the largest stocks. They try to weight it so that it matches the economic activity of the country. And I've been in the GICS industry meetings before, so I know pretty well how it works. You get in there and they have detailed discussions and statistical analysis and talk about all sorts of different things. And they have a committee that makes a decision on whether they should increase or decrease a certain sector or add a new sector. And the reason I had been in there because I was the real estate analyst at the time, and they were thinking about taking real estate out of the financial sector and making it its own sector. And sure enough, eventually they did. But you can see it's broken down this way. Information technology, 27%, healthcare, 14%, consumer discretionary, 11%, financials, 10%, communication services, 8.4%, industrial, 7.9%, consumer staples, 6.8%, energy, 4.7%, utilities, 3.1%, and real estate, 2.9%, and basic materials, 2.5%. Now, if you were in the recap class that we did earlier or late in the week last week, we talked about this in more detail, and I don't think we need to beat this up over and over again, but I just want you to know how this works, because this is how we break down our portfolios when we're analyzing whether or not we're diversified or we're deciding if we're going to be overweight or underweight. So by definition, if you only have 4 team members and you only have 4 sector specialists, each of you covers one sector. Well, if you only have 4 sectors, and that means you're going to have about 20 to 30% of your stocks in each individual sector, and which means you're going to be underweight all these other ones. In fact, they may be completely deleted, and then these other pies slices are going to increase in size to fill in the area. Now, what does that mean? It means that if you're selecting more economically sensitive stocks and you're overweight those economically sensitive stocks, and the economy goes into a recession, your portfolio is going to go down more than the S&P 500. On the other hand, if you overweight consumer discretionary or consumer staple stocks, excuse me, I misspoke there, utilities, healthcare, maybe even real estate, things like that, and the economy goes down, well, those are much more defensive because people still buy food and beverage, and they still turn on the lights, they still use their heat, they still pay their rent, they still go to the doctor. Even when there's COVID, they still need healthcare, right? More so than ever. Now, on the other hand, if the economy does turn around and start to improve, then you'd want to be in the more economically sensitive sectors and be overweight those things like information technology, consumer discretionary, maybe even financials, maybe industrials. Certainly energy is a very cyclical one. Those tend to go up more when the economy is growing. Communication services is another big one. All right. Now, the reason we wanted to talk about this a little bit today is because some of the other investment competitions are copying us. So we announced our investment competition rules, and we always use the GIG system when we teach our classes. And we always, in our investment competition rules, we had a sustainability element this year. So the other investment competitions came out and they switched from the Russell index system to the GICS index system. I guess they like copying us, and they switched to more sustainability focused investment competition this year. So go figure. Anyway, that's it for my prepared slides. I will show you real quick where you can find some of the stuff. If you want to stay on top of this, and I suggest you do, then you can go to, let's put it in the chat. You can go to here, and this is a place where you can find updates on sector weightings in the S&P 500, and you can actually download that PDF right over here on the fact sheet. And you'll find out all sorts of stuff like the weightings, and let's see, do I have it open right now? Oh, I don't. And also you'll find out very handy things that you'll need. Here's the USD one. So I'll just open it here in the browser. There's some other handy stuff that you can use in there when you're setting up your portfolio, because when you're looking at valuation levels, things like growth, things like PE ratios, things like volatility, Sharpe ratios, you can see how your stocks are doing relative to the index. So it's not just about the weightings, but you can see the long-term performance. You can see the performance in every year. You can see the risk. Now this is measured as standard deviations. So you can see if your stocks are more volatile or less volatile than the S&P 500. And then they're calculating Sharpe ratios over here. And you can see that over the long term, the S&P 500 has a Sharpe ratio of a little under 1. So you can calculate your Sharpe ratio. When picking stocks based on valuation, you can look at the trailing PE ratio, but I would suggest you don't. I would suggest you look at the forward earnings ratio based upon earnings projections, PE ratio, price to book right here, indicated dividend yield, price to sales ratio, and price to cash flow. So these are all really handy when you're seeing if your stocks that you're thinking about buying are more expensive or less expensive than the S&P 500. And here's that pie chart that I just showed you. It's right here. All right. So you need to know where you can find out about GICS. There's another one over here where they give you the sector breakdowns and the weighting of each of the sub-industries. There are 24 industry groups within the 11 sectors. And you can find this information online. This is at, oh, you know what? Hold on, I'll drop that in here too if you guys want to actually look at this. You're going to have to learn about it for some of the other, if you want to know how this works, because there are certain rules in certain investment competitions regarding you have to have at least one stock in each sector per teammate. If you have 4 teammates, you have to invest in at least 4 sectors. And if you have at least, you can add more. If you want to invest in all 11 sectors, that's fine. Let's see. Which one is this? Yeah, there it is right there. And I don't know why it's showing the wrong, I guess because I already downloaded it. Let me see if I can cut and paste it. So I don't know, Lynn, is that a rule for YSIC? Lynn knows the rules of YSIC better than me because he helped write them. Oh, well, I guess I can't get it. All right. So it is a rule for other investment competitions, and it's not. I don't know if it's a rule. I don't know if Lynn's listening. It's not necessarily a rule for us, but it is something that I recommend and that I teach in my classes all the time. You do want to stay diversified across all of the different sectors to a certain extent. So you want to have some exposure in order to keep your portfolio diversified and reduce the risk, yet still have positive returns that can hopefully beat the market. You want to pick the best stocks you can, but you want to have about 20 to 30 stocks because statistically that reduces the standard deviation of returns to a point where it's almost as low as the standard deviation of returns of the index. However, you don't necessarily want to buy all the stocks in the index. You could do that if you wanted, but you can't beat the index then if you own all the stocks. See what I'm saying? If you own all the 500 stocks of the S&P 500, you might match the S&P 500, but you can't beat it. The goal is to pick the stocks you think are going to outperform and sell the ones you think are going to underperform, and just have a portfolio of at least 20. Now, you're going to have at least 20 because we did put a rule in that I know where it's the same as the rules for the law for mutual funds, that if you say you're a diversified mutual fund, you're not allowed to put more than 5% of your assets under management in any one particular stock. So that means, what's the inverse of 5%? It's 20. You're going to have to eventually buy at least 20 stocks if you want to deploy all of your cash. So be cautious next week, but I think things will be fine. Like Professor Siegel just said, over the long term, stocks outperform all other asset classes, even after adjusting for inflation. Sure, they may be more volatile for a period of time, but bear markets don't last forever. And there will be bear market rallies. And at some point, the Fed will say something nice about not having to raise interest rates as much anymore. And the market will suddenly start to rally.